Welcome in our next guest on the show, Rohit Agarwal, Equity Fund Manager of Kotak Life Insurance. Rohit, thank you so much for taking out time for us. First, if you could just tell about the markets, what's happening in the market, especially after demonetization, the US update that we've seen on the election side. Do you think markets are still in an adjusting phase, trying to find what level should be suitable?
Yes, that's right. The markets are still in an adjusting phase. As you rightly mentioned, that after the demonetization, there have been a lot of global events as well. If you actually see what's happened is, global bond yields have gone up. The US GDP is tagging along pretty nicely. And you have seen the US 10-year at about 2.5%. But apart from that, you've also seen that the global commodities have gone up. And that at the margin hurts the Indian economy. And that's why you see that the process of adjustment of the Indian markets is a little more protracted and more elongated. You see that adjustment happening. We believe that adjustment will take maybe another quarter or so. And after that adjustment is done in terms of the global macro, and of course our own Indian economy getting used to a new way of life and getting used to a new digitized way of life, things will get better from here on.
Right. What do you think in terms of flows? Domestic flows strong, FIIs are seller. For the near term, markets can manage any major FII selling?
We think so. As you rightly said, FIIs have been sellers. But if you see, the FII selling in November was about $2.5 billion in the Indian equities. In December itself, it has come down to about $200 million, $300 million. So at the margin, that selling also is receding. But we have to bear in mind that the selling by the FIIs in November was not necessarily demonetization led. And we believe it was much more global led, where you saw global yields going up, and hence there was a pressure on the whole emerging markets as such. You saw some money shifting from countries like India and China to countries like Brazil and Russia, which are net exporter of oil, and hence there was some shifting of money there. But overall, we believe it is not necessarily to demonetization that the FIIs were sellers in India. At the margin, as you see, that the selling is already abating. But the silver lining here is the domestic flows. Now, the domestic flows are strong because of the effect of demonetization and the impact that it have on the Indian financial system as a whole. We believe going forward, the shift from the physical assets to the financial assets will actually accelerate. India consumes or imports about $25 to $30 billion of gold every year. We think that number can easily halve in the next 2 years. All of that money would probably channelize into the financial system. The investments that used to go into property, that will come down. That itself, again, if channelized into the financial system, will lead to a lot of gains. And hence, we expect that the support that we have seen from the domestic institutions, be it mutual funds or insurance, will continue. And if anything, we think that it can likely accelerate going forward.
But when do you think the benefit will come? Probably post FY18, once the adjustment phase in the next 2 to 3 months is over?
I think the economy starts to see the impact from FY18 onwards, but the markets will start reflecting it as soon as they get a sense of where it is starting to move. As things stand today, the situation is pretty fluid, where people are not necessarily sure as to what is the short-term impact on demand, what is the short-term impact or longer-term impact on demand and supply. And hence you see the caginess amongst the market participants to take a very big call. But all of us do know that over the medium to long term, it is a very, very good move. And as soon as you see some little semblance of demand and direction coming in, the markets will start to reflect in that, because markets are always forward looking and they will be able to look through 1 or 2 or 3 quarters of pain as and when they get the confidence that this is where the things are headed. For example, we believe one of the major beneficiaries will be the banking system. Just to give you an analogy, currently demand has been impacted. There is hardly any demand growth, hardly any loan growth for the banking system. That too at a time when they are flushed with liquidity, flushed with funds. But if you see what the government is trying to do today, around $95 billion of petrol and diesel purchase in the country is today paid by cash. If only 50% or 30% or 40% of that moves to the digital way of paying, imagine the impact it can have on the financial system as a whole. Now, this is just a small example, but this will inculcate and permeate into our different walks of life, and things will change for the betterment.
Right. In terms of FY18, you expect a very limited sort of a EPS downgrade?
Yes. If you see what's happened, we actually believe that there's a very high likelihood of mid-teens to high-teens growth in FY18 on the EPS. If you see what's happened, global commodities have gone up. So if you see some of the sectors which are very, very commodity dependent, or which are the commodity sectors, their earnings will see a sharp rise in estimates. However, the earnings of some of the consumer of the commodities will likely go down. But for that you have to see, that is the impact that they will have on the margins. But what will be the impact on the EPS? That remains to be seen, because if demand comes back after 3 months or 6 months, if demand is higher than what people currently estimate or envisage, then some of the impact that is likely to happen on the gross margin of some of these users of commodities, that will likely be neutralized by a higher top line. And when there is higher top line, there is higher operating leverage within the system, and that percolates or takes care of some of the margin pressure that may come through because of the using of commodities.
Say if the dollar index were to go up, don't you think a lot of exporting names would start to do well? So IT, pharma, big contributors to the EPS and EPS growth, their outlook should actually improve.
Yes and no. Yes, because if you see, it's already happening in the market since demonetization. If you see, the IT sector and the pharma sector have largely outperformed the market. The IT sector theoretically benefits if the rupee depreciates when the dollar index rises. But even if you see, look at the Indian currency, it is depreciated very little versus the dollar. Not too much. Actually, it is appreciated against some of the other major currencies of the world, and it is only the strength of the dollar which is actually making it depreciate a bit. If we actually see, India's competitiveness versus some of the other regional currencies has actually gone down because we have depreciated less. Having said that, if you look at IT, history does not suggest that IT necessarily benefits a lot from a depreciating dollar. That is more a mindset issue, because if you see, generally the depreciation of the currency happens either, as you said, there is a very strong dollar, or the Indian economy itself is not doing that great. But if you see, barring 2007, when there was a huge appreciation in the currency, in most of the years when there has been a depreciating INR, if the global growth is very good, which has happened in the past, it more than takes care of some of these things. If I have to flip that on the other side, when INR appreciates, it is generally seen that the global growth is very good. And that's been the time, except as I said, 2007. When the top line is very strong, even INR appreciation is taken care of by the IT companies. In current circumstances, when rupee might depreciate or is depreciating, some of the companies might be able to hold on to their margins, but it does not necessarily add too much to their bottom line, because their customers who renegotiate their deals for them, mostly on a yearly basis, come out very hard on them, and they know what are their costs. And hence, it is mostly a top-line game, a revenue-driven game. Currency, at the most, can be in between, used as a tool to manage margins, but not as a business model. Having said that, on the other side, if you look at pharma we believe...
Go ahead, Rohit.
Pharma, we believe, is much more of a bottom-up sector. If you look at some of the pharma companies, they have their challenges, their own challenges. The first set of challenges was through the US regulators, the US FDA, which came down pretty hard on the Indian companies for the kind of manufacturing practices or the manufacturing operations that they were carrying on. Most of that pain seems to be over. However, if you look in the US, what's happening is there is a general pressure on the US generic pricing. Now, most of the Indian companies that we talk to seem to suggest that there is a high single-digit pressure on generic pricing every year. Now, that is itself not a great thing. But having said that, if you look at some of the companies which are US-focused in particular, companies find it easy to scale up to $1 billion of US revenues, and that's when they start to struggle a bit. And that's when they need to branch out, that's when they need to really come up with strategies to grow further. But companies who are into $100 to $300 million of US sales in the pharma companies, they are the companies which are in a sweet spot where we believe they can scale it up to $500 million to $1 billion of sales annually pretty easily. So pharma being a bottom up, it does not necessarily benefit from the Indian rupee depreciating, but it does make life a little bit easier for them.
Right. In terms of dollar index going up, it can also lead to a lot of outflows in the near term, which is also a risk to asset prices. Even if there is value, it may take some time for a big investor to come in.
It's possible, but we don't think it's inherently something that's going to happen in a big way. The reasons are, as you yourself talked, that in FY18, if the earning expectations is mid-teens to high teens, and FY19 again the same, India is likely to be a country which is going to offer probably the highest index EPS return. When that kind of thing happens, it's pretty difficult or hard for somebody to take a medium to long-term view of a negativity on India. And hence, we believe, barring short-term interruptions and barring short-term outflows, which may happen, more related to the hot money, which is more ETF based, we believe that long-term money will actually flow back into India if that happens, unless of course you believe that the dollar index has a lot of steam left. But we believe it is not going to necessarily happen, because if the dollar were to keep appreciating for too long, almost the whole of Detroit will go bankrupt at some stage.
Right. And why are we not in an environment like Jan 2016 or what we saw back in 2013? What's the difference?
I think the inherent strength of the economy is much better. If you look at the Indian macro itself, even if you look at crude, which has gone up 20-30% in the last month or so, it's still hovering about $55 or so. Now till 60-65, India is relatively all right. It's only after that we start to worry about what to do. Even after that, even though there has been a lot of media attention about what will happen to the petrol and diesel prices, if you see, the government has around 12 rupees of extra excise on petrol and broadly the same on diesel, which it can play through if the need arises. The Indian macro is better, Indian interest rates are lower, Indian corporate leverage is not very high, and hence, and also this demonetization, which is a very good step, which also gets the informal economy into the formal economy, which has a better multiplier. The move from physical to financial assets, which again is deflationary, because the investment in physical assets is inflationary, the investment in financial assets is less inflationary. All of this gives a good macro backdrop for the country. When all of that happens, it is basically a precursor for better earnings and growth visibility. And when that happens, the markets, with a lead and lag of a quarter or two, will finally follow the earnings that the market delivers.
Right. So which sectors are you looking at, especially after this correction? Which sectors, according to you, are attractive, which have seen a fall, but earnings outlook is not much changed?
I think, as we mentioned, banking is one sector which we believe is a very big medium to long-term beneficiary. The effects of demonetization will start getting reflected maybe after a quarter or two. Initially, you will see some hiccups in terms of loan demand being not there, and some asset quality issues which may creep up on the SME side of things. But as things normalize, the banking systems gets more formalized, more and more people start transacting with the banks, they are a great beneficiary going forward. We believe even the consumption sector will come back. Within consumption, it may take a few sectors which are discretionary in nature a little longer to come back, but some of the non-discretionary items which are like two-wheelers and four-wheelers, which is more likely rural focus, where we expect the government to come out with some social schemes, with some infrastructure schemes, and some ways to pump up the economy. There you will see the demand coming back pretty fast. So things like autos, things like cement, which is basically a precursor, which is a raw material to housing, which we believe can be a big initiative from the government going forward. They have talked about housing for all in the past. For all we know that they may come out with a big bang scheme on housing, and just again create the demand for cement and some of the ancillary products that go into it. So consumption, we believe, will make a comeback. But in consumption, we believe one needs to be selective, where the discretionary high-end consumption will take time to come back. But some of the middle level and the low level consumption items will see come back within a quarter or two. And hence, we have been investing into banking, autos, and some of the consumption-driven economies.
Let's start with the banking space first. In the near term, of course, as you said, that they would benefit from the liquidity, but at the same time, the demand for loan would go down. And they have now started to get a lot of competition from these payment wallets. Do you think that the loan recovery or the loan growth would pick up very fast once we have the currency remonetization process fully done?
I think the loan growth recovery itself before the demonetization was pretty low if you actually look at the data. Hence, it is very difficult to predict when loan growth will pick up. But it suffices to say that within 1 or 2 quarters, you should see things getting back to normalcy, and hence you should see demand pick up. If you do not see that, then it is not just banking, it is the economy itself which we believe you will have to assume will have to go through a longer pain and the adjustment process will be longer. If we are of the assumption that the economy is going through a tertiary pain of 1 or 2 quarters, then the banking system and the banking loan growth, which is basically a function of demand from the economy, will come back with a leader lag of 2 quarters.
Right. And what is your internal view? Do you think that this recovery could be way longer in terms of any major growth that we can see?
We have been talking to companies constantly, and if we actually see that the feedback is very mixed. Some of the companies suggested to us that November was very good. In December, when we spoke to the same companies, they seemed to suggest that November was probably good because there was a lot of stuffing which went on within the channel itself, and hence the channel carries a lot of inventory with itself. What will be interesting to watch will be January, when we will see the December data coming out, as to what is the actual relevant impact on demand. If we see December data itself getting very, very weak, which actually if we see market participants are expecting it to be weak, from January onwards, most of the companies that we talk to are seeming to allure or guide to us that things should start looking better. Having said that, it is very, very difficult for even the companies to guide us in such times because there is no empirical evidence which lies with us. Hence, we'll have to take data as it comes, data at different points of every fortnight as to how they suggest as things are. But as things stand today, we believe after a quarter or two, you should see things getting normalized.
Think in terms of primary markets, what's happening? Do you believe fundraising activity, primary markets, new sectors getting listed, all of it will continue in 2017 also?
Yes, broadly. We do not necessarily see too much of an impact. There is a hiatus, as you see, that the pace of new listings have reduced at the margin a bit. But that historically happens during the year end when most of the FIs generally tend to go on a holiday. But as things start to normalize, you'll see bunched up listings, we believe, coming through again. So we do not necessarily see a lot of impact on new primary listings just because of what's happened in the recent 1 month or so.
Right. And in terms of, auto, which you said earlier, could you just say why do you think auto consumption would not categorize as, luxury consumption, and that's why it may take some time to pick up?
See, within auto, there are different spaces and different companies. Within auto, if you look at two-wheelers, that is certainly not a luxury consumption. A two-wheeler bike, which typically costs 40 to 50,000 rupees, would not get categorized as a luxury consumption. Now, what's happened in the two-wheeler sector, that out of that sales of two-wheelers of even 40,000 to 50,000 rupees, a component of cash was pretty high. Now, that adjustment needs to happen. Now, people are adjusting, companies are adjusting. The channel needs to adjust, the channel financing of the two-wheelers need to adjust to that. I think that adjustment is already underway. And with the pay commission money which has come into the hands of the people, with the expected dole out from the government on the rural side, on the rural income side and the rural farmer basic income side, we believe that this area of two-wheelers could see demand coming back relatively earlier versus some of the discretionary high-end luxury items. For example, a car which sells for 15 lakhs to 20 lakhs and above, that kind of consumption has seen a higher impact, and that kind of consumption will see a longer time to come back. Even within autos, if you see four-wheelers, some of the four-wheelers which are cars primarily, which start with a range of 4 to 5 lakhs, there again the demand will come back pretty fast. The reason being that a lot of demand or sales on the four-wheelers at that end of the spectrum already was happening through financing. And the financing cost being low right now because interest rates are pretty low, it spurs the idea to consume, and hence the probability that people will go and buy four-wheelers again at that 4 lakh to 6 lakh rupee range is pretty high. Again, a car above 10 lakhs will see a little higher impact. Cars above 20 lakhs or so will see even higher impact. Then in autos, you also have CVs. Now CVs immediately saw a big impact and demand was pretty much down. But again, if the economy has to come back and if there is going to be a housing scheme or social infrastructure, metros, bridges, all of that getting created, most of the demand should come back. Plus, let us not forget that there is the impending GST which is likely to start in 2017. We still don't know the date, whether it is April or September. We believe somewhere in between that is likely when GST should start. If that happens, a lot of it as it is will get streamlined and there will be already a demand for CVs which will be preloaded and you will see a lot of demand coming back. So in autos, we need to always segregate. For example, even the auto ancillary companies will actually benefit from the healthy auto sales which we have seen in the last 2 to 3 years, because the auto ancillaries are nothing but basically half of it is likely to be OEMs, new sales, and half of their sales is replacement market. And whatever sales that the auto OEMs did in the last 2-3 years, that replacement demand will now come into the market. And hence in autos, we really need to segregate as to which companies segregate to which kind of demand and then take a stock call.
But do you expect more launches now from some of the auto majors to come in towards the slightly lower end in the range of 5 to 10 lakhs?
When we speak to the companies, as things stand today, they do not necessarily tend to suggest anything of that sort, because these things are planned pretty much in advance. So we haven't really come across any company come and tell us that we have changed our plans and instead of launching something at the premium end, we are now going to launch at the lower end. However, these things can materialize over a course of the month or a quarter, and we have to watch out as how do the companies commentaries come out after a quarter, after they assess as to how demand conditions are, and if the companies believe that demand is going to be higher, and if they see that demand actually is higher at the lower end, I'm sure they will be pretty quick and nimble and come out with more launches on that spectrum.
Right. What do you think in terms of oil marketing companies? Will they start to trade at multiples of consumer or something like a Maruti, which has consistent demand growth?
Well, currently they are way off those multiples. But what we believe of OMCs is what we saw just last Friday, that during the week the whole market got very nervous that are we going to have the same thing again and again, where the independence of the OMCs will be questioned, challenged, and there will be a lot of interference from the government side as to when to take price hikes, what kind of margins to make. But as we saw on Friday, the OMCs took a price hike and the margins of per litre of diesel and petrol is maintained. If that continues, we believe there is no reason for the OMCs to keep trading at lower multiples. The multiples, if you see in the last 3 years, have already re-rated. Having said that, we do not believe that the OMCs will go to the consumer sector multiples, nor do we believe they will go and trade at maybe a Maruti-like multiple. But somewhere in between the current multiples that they currently trade at and where Maruti trades at, may be a likely multiple that they may settle at. Because the long-term growth or demand growth or volume growth of this sector is likely to be lower than what a four-wheeler, something like a Maruti, may end up doing, which may be a double digit. For these companies, a double-digit demand every year will be a little bit of a challenge, and hence the multiples may be slightly lower than that.
In terms of oil marketing companies, last year was the first full year, where we saw, the financial impact of, the entire oil marketing companies getting the free pricing. We'll get this year as well. And as you're saying that, if price hikes are done, margins are maintained, do you think the multiples will rise as we start to get numbers, as they start to pay off their debt and generate free cash flows?
That can happen. That's something which can happen. And if you see after the initial hiccups which market believed in, we believe things will get on track. And let's not forget, the OMCs is also one of the sector where the impact of demonetization is pretty low. The impact, if any, is on the demand side, which again is not very high. And we believe, as you said, they generate good free cash flow, they pay down debt. That should lead to higher multiples. However, they are also thinking about putting a big refinery, all three OMCs put together. So we have to see how it goes as to how much free cash flow actually comes through and how much is finally distributed to the shareholders. But yes, if there is free pricing, there is good cash flow, you can pay down debt, and hence the multiples should start looking up a little bit.
Right. Cement has corrected, and you mentioned that it would be one of the top overweight sectors that you would be looking at. Is it after the correction that you're looking at cement in terms of being an overweight?
Now, cement, as you said, has corrected. Now, cement is, again, basically you have to see it very region specific. Having said that, in cement we believe that we have to always play a balance sheet of a company. It is basically a commodity, but a different type of a commodity. It is not like an infra commodity or a steel or an aluminium or a copper commodity. If you see this cycle versus the last cycle, the difference is that most of the balance sheets of the companies in this sector are way, way healthier than what they were in the last cycle. And hence their ability to take this pressure on demand, on pricing, and hence margins due to demonetization, which we believe is a short-term interim impact, is way, way better than what it would have been in the past cycle. If we believe or if we see some of the government initiatives coming through on public capex, on public infrastructure, and on housing, we should see cement demand coming back. And selectively, we believe that some of the cement companies which have very good balance sheets and which continue to expand without using any or very minimal debt will continue to deliver returns in the medium to long term.
Right. Always, fund managers who have a long-term view, and especially from the insurance side, the view even gets longer. Would you look at sectors like, real estate, probably telecom, totally beaten down? People don't have any expectations of growth into this sector. In fact, people are expecting margins to go down further, debt to rise further. As a contra player, which sectors would you be looking at?
Well, as a contra player, currently we are not necessarily looking at telecom. We believe that with the impending entry of Reliance Jio into the market, the balance sheets of the incumbent telecom operators will see a lot of pressure. And you see them already actually starting to adjust to that reality and also starting to create cash on their balance sheets to take on the behemoth. Having said that, if you actually look at the return on capital employed of the telecom companies, even before the impending entry of the behemoth, they hardly meet their cost of capital. What that tells us is that this sector does not generate shareholder returns over the longer term. And now you have an added entry of Reliance Jio. So even as a contra play, as things stand today, we are not necessarily looking at telecom to get into. For contra play, actually we have been looking at cement. Cement is basically a sector which has got impacted by demonetization, and it is also a sector which has seen some of input cost increase in terms of petcoke prices rising. And hence the impact, the near-term impact on earnings is pretty large. But we believe this is a sector which actually is one of the worst performers after the demonetization, can be a good medium to long-term outperformer when things normalize. If things do not normalize in the near term or take longer to normalize, the cut in the cement earnings and hence the stocks could be little larger than what people anticipate. But it can be worth the wait, we believe. But if you look at a 2-year to 3-year time frame, we believe that cement is a sector where there's a lot of money to be made, and hence is a contrarian sector actually. If you see, after demonetization, it is one of the worst performing sectors, and hence a contrarian bet in our view.